Let's get to our market panel. Joining us now is Wilmington Trust Head of Investment Strategy, Megan Hsu, Jefferies Chief Market Strategist, David Zervos, and our own Steve Leisman. Steve, first to you, to extend the metaphor from yesterday, it looked like Powell's hawkish tone might wake the baby with the market, but then did it just sort of roll over and go back to sleep?
You know, John, there's a lot of babies out there. Most of the babies were kind of sleeping. One of them is sleeping a little better now. The stock market feels like it maybe dodged a bullet here. Yields look a little flat here, except for one market that I'm following that seemed to wake up as Powell tiptoed into the room, which was the outlook for November Fed funds futures. Now, this is very volatile and it's a big hedging market, but if you look at the probabilities for November, we're up quite a bit over the last couple of days, 56%. Remember, we were at 50% this morning, even after Powell spoke, down in the 40s below. That could change a lot. There's a lot of data to come, as they were just talking about in the last hour. But what I think that on balance conclusion is that, you know, Powell's maybe a bit more likely to hike than maybe we thought early in the morning. There were a bunch of triggers, like he said. If the labor market fails to ease more than we expect, that could lead to higher rates. If the economy fails to cool as much as we expect, that could lead to higher rates. And you'll notice he didn't say the word cuts at all. He's not talking about that. He's talking about holding steady at a higher rate. So that's the choice for the market to figure out. Not if the Fed is going to be cutting anytime soon or even in the near horizon, but are they going to hike at least one more time, or are they going to just hold steady? That's who the doves are these days, the hold steady group, John.
Okay, but not very dovish anyway, Steve. Okay, David Zervos, also a bit of a vagueness in the wording here. You think that's pretty intentional?
I do, John. I mean, we've been writing a little bit about bringing some of the Greenspan era purposeful obfuscation back into the market lexicon or the Fed speak lexicon. And I think he's done that. I think he left himself a lot of options. He definitely gave us a Volcker-esque hawkishness, but he also had that kind of confused Greenspan tone. And the market reaction, I think, would have made Greenspan proud. He didn't really move the dollar. He barely moved the front end. Steve's talking about, you know, a few percentage points here or there. And the equity market barely about 0.5%, a little bit more. I think that's kind of what he wants. He wants to be sort of in a world where he's not really giving a lot of indications. He's not forcing the market into taking big positions either way, and maybe having a pretty diverse market view out there, which in the end I think should reduce volatility.
Talking tough, but not waking the baby. Megan, strategy then is what, or should be what for investors, especially after the market didn't really rally at all post NVIDIA earnings. I mean, this has been something that's been cautious from here. Do you stick in fixed income for a while?
Yeah, John, I think you have to be patient when it comes to the equity market. We've been really focused on rates. That's been the story of August, and not just the increase in nominal rates, but the increase in real rates. And that's a major headwind for equities going forward. I think as we look at where rates are today and kind of that risk reward for fixed income, it's pretty attractive. If rates move maybe a little bit higher, you're still getting a nice total return given where rates are for investment grade fixed income. But we think that it's more likely that they're going to move lower because a lot of what has driven the equity market through the summer, as well as the increase in real rates, has been this expectation that growth will come in much stronger than we expect. The Atlanta Fed GDP now at 5 to 6%, we think is way, way too high. And the economy is more likely to be growing at a run rate of about 1 to 2%. So that says rates should move lower, even if we don't have a recession. And that sets up nicely for fixed income. I would just be really careful on duration, looking at short duration and long, but staying out of the belly of the curve, as well as really being focused on quality investment grade, not taking too much credit risk.